Hey, it's Jason here. I wanted to give you an FYI that deeper into this video, towards the end, I share with you a strategy that you can use as a deal maker that basically takes the best of both worlds. It takes the best of continuing to grow aggressively while simultaneously not over leveraging yourself so that you're exposed, especially if recessionary times continue and perhaps get worse. And so I share with you at the end what we do and what we're doing. But to really understand our strategy, it's important that you understand the spectrum of options available to you as a deal maker with regards to paying down debt and conservatively cleaning up your balance sheet through a traditional means versus going on the offense and acquiring more assets or growing organically, perhaps by taking on more debt and utilizing that capital to get an improved ROI. So with that said, let's get into the main part of the video. Thanks for watching.
I was working with a client here earlier this week and I got a question. And the question was as follows. Jason, do you recommend paying off all your debt whenever you can when you're out here buying businesses? Or should you save that cash and use that cash which you've saved to go buy more companies? Right? And this, in a nutshell, is really the divide between a conservative business plan, whereby you just funnel all your free cash flow at paying off debts, versus a more aggressive business plan, whereby you stockpile cash and then utilize that cash to either grow your business or to buy more businesses. Okay, and this, in a nutshell, is really one of the big decisions you have to make in the game of buying businesses and in the game of business ownership. Once you recognize that yes, there are ways to grow your business organically, there are ways to grow your business through acquisition, and there's also ways to de-lever your business by paying down debt. What do you do? And I want to give you some thoughts and considerations as you go through this process and this decision-making process. Okay, so firstly, the most aggressive thing you can do, in my opinion, is to only pay off your principal balance, your base amount of debt each month. That's negotiated between you and your lender, or you and your lenders, plural, if you have multiple debt instruments within your company. And as you go through acquisition, you almost certainly will, right? So the most aggressive thing you can do is pay off only the minimum amount and then take all that cash and utilize that cash to go out and buy more businesses and or go out and organically grow by opening more locations, buying more equipment, buying more vehicles, recruiting, marketing, spending dollars in these organic growth means, okay? And that is, again, the most aggressive way you can play your hand. Now, the most conservative way, again, is paying off your debt aggressively. Every chance you get, you just throw the money at the debt. You do not grow at all until you've paid off most of, if not all of your debt. Okay, and that, in a nutshell, is the overarching, let's say one end of the spectrum and then the far-reaching other side of the spectrum. And what I have to talk about in this video is really why playing it conservative is great if you want a simple life, but why playing it conservative is a really bad play if you're super confident about your ability to execute a successful roll-up. Because here's the real thing, right? Understand that as you make more acquisitions in the game of M&A, mergers and acquisitions, as you make more acquisitions, especially in a given market and in a given industry, as you continue to make more acquisitions, the exit value of your portfolio of companies will rapidly increase, right? So whereby if you buy an individual business for say 3 times earnings and another individual business for 3 times earnings and then say a third business for 3 times earnings, if you package those businesses together and then sell them for upwards of 6, 7, 8, 9, 10 times earnings at some point in your career, the spread you made on those business acquisitions is massive. Again, buying businesses at 3 times earnings and then down the road selling them at 10 times earnings, I mean, it's huge. It's over 300% spread that you've created. And again, if you buy those businesses at 3 times your earnings using other people's money, meaning not using your own capital, then you've legitimately created an infinite return on investment for yourself. Okay, and this is why expanding through acquisition as opposed to paying off all your debts can be a very useful strategy, because you can take that free cash flow and you can use it to go out and buy more of these companies and to grow the overarching exit value of your portfolio of companies. However, it's more risky, right? When you're going out and buying more companies, almost certainly you're going to be doing so with debt. And so what this means is if you misstep at any point, if you don't have a healthy cushion between your debt obligations each month and your free cash flow post-debt at the end of each month, if that between your portfolio of companies gets real thin and you keep going on trying to buy more companies and then that next deal you do fails, falls on its face, you could be in a situation where you really struggle to cover your debt service. And if you're highly levered, especially with high interest debt on a very short term, on a short amortization period whereby you're paying that debt off really aggressively, you could come into a heck of a problem. But the alternative of aggressively paying off your debt without expanding will certainly mean it's going to take you many more years, and if not several decades, to build meaningful wealth through M&A. The real way to build wealth more quickly is, again, to engage in a roll-up, to acquire a bunch of companies in a given sector, and to essentially continue to aggressively grow as opposed to paying off every single dollar of debt. Right? Because your dollar of debt, you're essentially getting a dollar for dollar arbitrage if I pay a dollar of debt off. Right? So what happens if I pay $1 of debt off? Okay? I have one less dollar of cash in my account, and I have one less dollar of debt on the books, on my balance sheet. It's a dollar for dollar arbitrage. And a dollar for dollar arbitrage is safe. There's nothing profound about a dollar for dollar arbitrage. It is certain, hey, I have one less dollar of debt than I had. Okay, I used $1 of cash, an asset, to get rid of that debt. It is what it is. On the contrary, if I take that $1 and I use that $1 to buy a separate business altogether, and I know $1 wouldn't be able to buy you a business, but consider $1 to equal $100,000, for example. Okay, if I take that $1 and I use it to buy another asset, another business, another piece of equipment, if I use it to buy a building so that I can open another storefront, and if I keep doing that, again, by using that equity arbitrage that I talked about prior, I could take my $1 here and create $4 of value. I could take another $1 here and create another $4 of value, and then take another dollar right here and create another $4 of value. So in this example, I took $3, and if I paid down debt, in a sense, I would have gotten rid of $3 of liabilities, and in a sense, you could argue, increase my net worth by $3. Or I take these $3 and buy a business or an asset that is going to increase my portfolio value by each dollar, maybe increases my portfolio value by $3 or $4. Well, you see the expansion play there, right? So maybe with those $3, I create $12 of net worth for my company. The company is worth $12 more based on a $3 investment. In other words, an increased return on investment in simple terms. Okay? So there's no ifs, ands, or buts about it. If you really want to create wealth and aggressively pursue wealth, then the fastest way to do it is undoubtedly to use your cash to get something better than a dollar for dollar arbitrage. Period. End of story. Nobody can debate that. However, nobody could also debate the fact that taking your precious dollars and using them to buy more assets and partnering with lenders to give you debt to buy those assets is inherently more risky than is simply paying off your debt. Is the ROI much higher for utilizing your cash to buy more assets and businesses? Absolutely, if you get it right, no doubt about it. But the risks are higher as well. All of that said, there's one other thing we have to talk about before we end the video, which is a prepayment penalty. In some instances, with the deal you'll negotiate with your lender, in some instances, you will have to pay a prepayment penalty, which is essentially a penalty that you get when you prepay your loan. Now, you have to look at the terms of your loan before you sign to look for a prepayment penalty. But oftentimes, if you prepay your loan in full, say you have $1 million loan, and you decide after a month you want to pay off the full $1 million, oftentimes in that first year, you'll have a 3% prepayment penalty, which means if you pay off that $1 million loan in the first couple of months, you may actually have to pay $1,030,000. That 3%, that extra $30,000 is that prepayment penalty. And then on the 14th month, if you've been making payments each month, and then after 14 months, so just after a year, you decide you want to pay off the loan. At that point, often it'll be a 2% prepayment penalty. So if you paid off, say, $1 million loan after a year and a half, you may have to pay $1,020,000. That extra $20,000 is that 2% prepayment penalty, et cetera, et cetera. I've seen many examples where in the first year it's a 3% prepayment penalty, second year it's a 2%, third year it's a 1%, and then after 3 years, the prepayment penalty is gone. You can negotiate this away when you're dealing with a lender, especially if you have enough lenders competing for your deal, whereby you can play one lender against another and say to lender A, hey, lender B is not charging me a prepayment penalty. Come on now, lender A, what are you doing here? And then lender A will drop the prepayment penalty and boom, you've negotiated it away. So you can negotiate away prepayment penalties, but before you start paying dollar for dollar with your cash to pay off your debt, make sure that there's no prepayment penalties there. And also think about the opportunity cost of your money. The opportunity cost of your money. Because your dollars can do incredible things for growing your business's net worth and your business's market cap. But your dollars are also extremely important, especially in a recession, which at the time of recording, we're in. Without cash, you cannot survive. So cash is the most powerful accelerant, but it's also the most necessary component of simply surviving in a business. It's your oxygen. If you utilize your oxygen, you can achieve great things. You can climb Everest. But if you run out of oxygen, you can't even, if you can't even breathe, you'll die right then on the spot. So cash in a business is like oxygen. It's how you achieve the greatest things. You need massive amounts of oxygen, massive exertion to climb Everest, but without oxygen, you can literally just fall over and die right here, right now. All right, so this is how to think about cash. This is how to think about paying off debts versus using your cash for expansion. Hopefully you've liked this video. If you want to partner with me on investment opportunities, assuming you're accredited, go to brighterutilities.com. Go to jasonpaulrogers.com if you want to work with me and have me help you buy your first businesses, your first couple of businesses. And very lastly, subscribe to this YouTube channel and subscribe to me on my other social media platforms so I can keep talking to you about business, finance, investments, mergers and acquisitions, all that fun stuff. I will talk to you in the next video.
Since you stayed all the way to the end, I thought I'd record a really low quality video here. High quality as far as the content, but low quality as far as the production value, and talk a little bit more about what else you can do as far as growing quickly, but also being more conservative. This is especially pointed and important in a recessionary environment. And here's what I would do, or here's what we're doing that you can consider doing as well, which is as follows. We are essentially doing the best of both worlds, which is, one, we are still growing because you have to keep growing. If you're not growing, you're dying. That's my position, okay? But then secondly and simultaneously, we are also partnering with investors so that we are able to keep stockpiling cash while still growing, which is the ultimate form of using other people's money, for one. Yes, jasonpaulrogers.com to learn more information about how we do this. But again, it's the idea of the best of both worlds. By not utilizing your own capital, but by building your own cash reserves, you make yourself a more bankable and trustworthy institution. You start building institutional value. Your balance sheet has more and more cash, and yet you're using other people's money, which means you're not draining your cash account. You're keeping and maintaining and building to your cash account, yet you're raising equity from third-party investors, accredited investors. You're giving them a nice return, but at the same time, you're able to grow. So you're growing, but you're not depleting your cash account. This is what we're using and what we're doing with Brighter Utilities. It's something you should consider doing as well. But you need to build a track record in many cases to really be able to raise equity at scale. I know recently it's a lot easier for me to raise equity now than it was, say, 2 years ago. Okay? But this is something to think about.
Hey, it's Jason Rogers. Thank you so much for watching the video. Be sure to subscribe, thumbs up the video, and for more, go to jasonpaulrogers.com.